You know, when a company's earnings report drops, you kind of expect one of two stories. Things are going great, or, well, they're not. But every now and then, you get a report like the one from FirstCry's parent company, FirstCry Solutions, and it tells both stories at the exact same time. It's a real head-scratcher.
So check this out. On one side, you've got revenue climbing, up a really solid 12%. That's awesome, right? But then you look at the other side of the ledger, and their net loss hasn't just gone up, it's absolutely exploded, jumping by a staggering 153%. So more money is coming in the door, but the hole in the piggy bank is getting bigger. This is the central puzzle we're going to unpack today.
So, what is really going on at FirstCry? I mean, how can a company be growing so well and at the same time be losing so much more money? Is this a huge red flag, or is it all part of some brilliant behind-the-scenes strategy? Let's dig in, starting with the good news.
All right, first things first, let's look at the bright side, because honestly, there's a lot in these numbers to be excited about. The growth story here is totally real, and it's pretty impressive.
Just look at that top-line number. Over 2,400 crore rupees in revenue for just one quarter. This tells you that this isn't some small startup. FirstCry is a massive player in its market, and it's still finding ways to expand.
And what's really interesting is this growth isn't just a one-trick pony. Their main India business, up almost 9%. Their international arm is growing too. And then there's GlobalBees, their direct-to-consumer brand, which is just rocketing up by 22%. That is a seriously strong signal.
But hey, as you know, revenue is only part of the story. To really get a feel for how healthy a business is, you've got to look at profitability. And even here, believe it or not, buried under that scary headline loss, there's some really good news.
So for the first 9 months of the fiscal year, their adjusted EBITDA, which is a key way to measure how profitable the actual day-to-day business is, grew by 25%. This tells us that the core business is actually getting more efficient and making more money before you factor in certain big costs.
Okay, so if the core business is getting stronger, where in the world is all the money going? Well, a huge piece of this puzzle is a massive strategic bet the company is making on logistics.
They are pouring a ton of resources into building their own in-house delivery service, which they call RocketBees, and it's expanding fast, already in 22 cities, and it seems to be working. Delivery times are already down by 20%. For their target market, I mean, think about it, new parents who need things reliably and, fast. Controlling that delivery experience is a massive, massive advantage.
Okay, so the growth is solid, and the big investments seem to make sense. Now, let's flip the coin and look at the other side of the ledger. This is the part that totally spooked the market.
I mean, the sheer scale of the jump here is just wow. A net loss of 15 crore rupees in the same quarter last year has just ballooned to over 38 crore this year. That is a huge increase that you just can't ignore.
And the market, well, it reacted exactly how you would expect it to. The stock price took a nosedive, falling over 11% on the day the news came out. This just shows you the immediate, real-world impact of that bottom-line number. So what caused all this? Well, the company is basically facing a perfect storm of headwinds. Competition is getting way more intense, especially for things like diapers, and that's squeezing their profit margins. On top of that, they're juggling supply chain problems and got hit with some unexpected one-off costs from new labor laws.
This whole thing is, well, it's complicated. But to really understand the why behind these numbers, we have to go straight to the source and get inside the heads of the company's leaders. What's their game plan? So the first big question for the CEO, Supa Maheshwari, has got to be about that huge investment in RocketBees. I mean, in today's world, with so many third-party delivery services, why build your own? It's got to be incredibly expensive.
And his answer really boils down to one word: control. He argues that for their specific customers, young parents, a consistent, reliable, top-notch delivery experience isn't just a nice-to-have, it's absolutely essential. If you rely on others, you get inconsistent service. By owning that last mile of delivery, FirstCry believes it can build a level of customer loyalty that no one else can touch.
Okay, but what about the other elephant in the room? Competition. You've got all these new, speedy players popping up, promising lightning-fast delivery. How does a big, established company like FirstCry fight them off?
And on this point, the CEO sounds really confident. He basically says that, yeah, it's easy for new players to launch, but it's incredibly hard to grow and actually make money. He believes FirstCry's gigantic product selection and its trusted brand name create this powerful moat, one that these newer competitors are going to find really, really hard to cross.
So when you take a step back and you put all these pieces together, the good, the bad, and the logic from the top, a clear picture of a long-term strategy really starts to emerge.
And here's what it all comes down to. FirstCry is making a massive bet. They are deliberately sacrificing profits in the short term to pour money into things like logistics and customer experience, things they believe will lock in their dominance of the market for years and years to come. Their whole playbook really boils down to 3 core pillars. First, use rocket bees to create the absolute best delivery experience out there. Second, use their size and brand to defend their core business from all the new competition. And third, slowly and steadily make their international business more profitable before they try to grow it aggressively.
And that leaves us with the million-dollar question, doesn't it? FirstCry is trading today's profits for a shot at tomorrow's crown. In a market this fierce, where investors can be so impatient, is that a winning bet? Well, only time is going to tell if this very bold move pays off.
Welcome back to the deep dive. Usually when we sit down here, we are wrestling with a stack of articles, maybe a new manifesto on AI, or a 10-year trend report on climate tech. We cast a wide net.
We really do.
But today we are doing something completely different. We are zooming in, way in.
We are indeed. Instead of a library of sources, we are looking at a single image.
Just one.
A snapshot in time.
It is Tuesday, February 17th, 2026. And the subject of our investigation is a stock chart, specifically the daily chart for FirstCry on the National Stock Exchange. And I have to say, purely as a piece of visual art, it is terrifying.
It is certainly not something you would want to hang on your wall if you are holding a long position in this stock, that is for sure.
It is a sea of red. Just looking at it on the screen, it feels heavy. So our mission today isn't just to, gawk at a crash. We want to do a forensic analysis.
Right.
We want to treat this chart like a crime scene and figure out exactly what happened, why it happened, and what the specific arrangement of lines and bars tells us about human psychology.
Because that's really what a chart is, isn't it? It's a map of fear and greed.
That is the perfect way to frame it.
People often get intimidated by technical analysis. They see the candlesticks, the histograms, the moving averages, and they think it is advanced calculus. It is not. It is simply the collective emotional history of everyone who has bought or sold this stock over the last few months.
And the emotion here is pretty clear.
And looking at FirstCry today, the dominant emotion is undeniable. It's panic.
Okay, let's unpack this. We need to set the scene for the listener who might be driving or at the gym and can't see the screen. We are looking at the daily time frame. And the headline number, the closing price for today, February 17th, is 229.90.
229.90.
Now, to give that context, where is that relative to the rest of the chart we're looking at?
It is falling off the map. If you look at the visible range of data we have, 229.90 is effectively the floor. We are staring at new lows.
And that is where I want to start.
Yeah.
Because to understand the gravity of 229, we have to remember where we came from.
We did.
Let's rewind the tape to the left side of this chart. We are looking back at early November 2025. It feels like a completely different world.
Completely. Back in early November, FirstCry was trading up near the 353.75 mark. You can see that clearly on the y-axis scale. That was the ceiling.
The ceiling.
Investors were optimistic. The trend looked decent.
So, doing the napkin math here, we have gone from roughly 354 down to 230 in about 3.5 months. That's a massive haircut.
It is roughly a 35% drop. And for a major listed stock, that is a massive destruction of shareholder value in a very short window.
Wow.
But for a technical analyst, it is not just that the price went down, it is how it went down that tells the story.
Right, because looking at the slide from November through December, it's not a straight line down like a cliff. It's jogged. It's messy.
This is what we call a classic bearish market structure. You will hear traders use the phrase lower highs and lower lows.
Lower highs, lower lows.
Think of it like a staircase leading down into a dark basement. The stock drops, then buyers step in and push it up a little bit. That is the high. But they can't push it as high as the last time. They run out of steam.
I see.
Then sellers take over and it drops deeper than the last low. Lower high, lower low.
It's like the stock is trying to stand up, it gets to its knees, and then just gets shoved back down over and over again.
Exactly. And there is a specific visual cue on this chart that shows exactly who or what is doing the shoving. Do you see that smooth red line curving downwards?
Yeah, I see it.
It is hovering just above the price candles the whole way down.
It's almost perfectly parallel to the drop. It never quite touches the candles, just rides above them, like a lid on a boiling pot.
That is a moving average. Now, without getting too bogged down in the math, a moving average smooths out price data to create a single flowing line.
Okay.
In a strong downtrend like this, it acts as dynamic resistance.
Dynamic resistance. That sounds like something from a physics textbook.
Oh.
Unpack that for me. Why does a squiggly red line prevent a stock from going up?
It is purely psychological. Think about the traders who bought the stock during the drop in November. Maybe they bought at 320 thinking it was a bargain. The stock falls to 300. Now they are losing money. They are underwater. They are stressed.
I know that feeling. You're just praying for the price to come back up so you can get out without losing your shirt.
Precisely. You are bargaining. You say, just let me get back to break even and I will sell.
Right.
The moving average often represents that average price where people are stuck. So every time the price rallies up toward that red line, all those trapped traders say, thank God I can get out. They sell,
Right.
and that wave of selling hits the stock and knocks it back down.
So the line acts like an electric fence.
Ideally, yes. And you can see it happen repeatedly in November and December. Rally to the line, smack down. Rally to the line, smack down.
So by the time we hit New Year's,
By the time we hit New Year's, the stock had fallen from the 350s to the 250s.
100 points gone. Just like that.
Like that.
Okay, so that brings us to the second chapter of this story, the middle section of the chart. We enter January 2026. And looking at the shape of the graph, the behavior changes. The staircase stops.
It does.
It turns into a flat line.
This is the most deceptive part of the chart, and honestly, it is where most retail investors get hurt. This is the false hope phase.
I can see why. If I were holding the stock in January, I would be feeling a little better. It stopped making new lows. It's just grinding sideways between 260 and 300. It looks stable.
It looks safe. It looks like a base. In technical terms, a base is supposed to be a foundation for future growth. It looks like the bottom is in. But there's a massive red flag hidden in this section, and it is not in the price. It is in the panel right below the price.
You're talking about the volume bar.
The volume.
I see exactly what you're pointing at.
Right.
Right around the beginning of January, there is this gigantic green spike.
Huge.
It is the tallest bar on the entire chart by far. It sticks out like a sore thumb.
It is colossal. Millions of shares changed hands in that short window.
Now, help me out here.
Yeah.
Because my instinct, and I think the instinct of most people, is that green volume equals buying.
Right.
And buying equals good.
Mm-hmm.
If I see a massive green bar, I assume the whales are scooping up the stock and we are about to go to the moon.
And that is one of the most dangerous misconceptions in trading. You have to look at the relationship between effort and result.
Effort and result.
The volume is the effort. The price movement is the result. So ask yourself, if there was so much aggressive buying, why didn't the price go up?
Yeah. Looking at the price candles above that spike, they didn't move much. The stock didn't rocket back up to 350. It just stayed in that 260 range.
Exactly. This is a phenomenon called absorption. Imagine you are sprinting as hard as you can. You are exerting maximum effort. That is the high volume.
Okay.
But you are running into a hurricane force headwind that is matching your speed exactly. You are running, but you aren't moving forward.
So the buyers were sprinting, but the sellers were matching them step for step.
For every share someone wanted to buy at 260, there was a seller effectively saying, here, take it. I want out. I do not believe in this anymore.
Oh, wow.
The selling pressure absorbed all that buying demand.
That is actually really bearish when you think about it. It means there is a massive supply of people waiting to dump the stock, even at these low prices.
It is incredibly bearish. It is what we call distribution. Smart money often uses that sideways chop to unload their shares to the retail traders who think they're getting a bargain.
So that volume spike.
That volume spike wasn't the start of a rally. It was the transfer of baggage from the professionals to the amateurs.
That is dark. But it explains what happened next. Because the floor didn't hold.
No, the floor collapsed.
Let's move to the far right of the chart.
Hmm.
The present day. February 2026, the last 2 weeks. The sideways grind ends, and we get this waterfall effect.
The support level at roughly 260 finally snapped. And in markets, when a support level breaks after a long battle, the move is usually violent.
Why is that?
Everyone who bought in January expecting a bounce. They are now wrong, and they are all rushing for the exit at the same time.
Which brings us to today. Tuesday, February 17th, I am looking at the very last candle on the right. It is a long red bar.
It is.
Walk us through the anatomy of today's trade, because I think the specific numbers tell a story of their own.
This is a brutal candle. Let's look at the data points. The stock opened this morning at 239.0.
Okay, 239.
It made a high of 239.20.
Wait, so it only went up 20 pays from the open.
20 pays. That is nothing. That means the bulls had control for maybe 3 seconds after the opening bell.
And
then the bears took over completely. The price fell all day long, hitting a low of 228.10.
And it closed at 229.90.
Right. So it closed within pennies of its absolute low for the day. In Japanese candlestick terminology, when you have a candle with almost no wicks, meaning no little lines sticking out the top or bottom, it shows total conviction.
It's solid red. A brick.
We call it a marubozu, or close to it. It means the sellers were aggressive at the open, aggressive in the middle, and aggressive right at the close. They didn't take profits. They didn't ease up.
They just kept selling.
They pushed it into the dirt and kept it there.
That implies momentum, doesn't it? It feels like if the market opened tomorrow, this selling would just carry over.
It strongly suggests that. There is no sign of exhaustion yet. The sellers are still fresh.
Now, I want to layer on some of the technical indicators visible here because they paint a picture of just how extreme this move is. We've got these 2 wavy green lines that sandwich the price.
Ah, yes.
I recognize those as Bollinger Bands.
Yes, Bollinger Bands. They are one of the most useful tools for measuring volatility. Think of the bands as a statistical boundary. They tell you where 95% of the price action should take place based on recent history.
So it's like the guardrails on a highway. The car is supposed to stay between the lines.
Precisely. But look at what the FirstCry price is doing right now in February.
It is crashing through the guardrail. It is riding along the outside of the lower green line.
We call that walking the bands. It is an outlier event. It means the price move is so strong and so fast that it is stretching the statistical probability of the stock.
Is that a signal to buy? I mean, if it is outside the normal range, doesn't it have to snap back like a rubber band?
That is the intuition, yes. But in a crash, that intuition gets you killed.
Really?
When a stock walks the bands, it indicates a state of high volatility and panic. The rubber band isn't just stretching, it is being pulled by a truck. Betting on a snapback while the price is still riding that lower band is incredibly risky.
You're just getting in the way.
You are standing in front of a freight train arguing about statistics.
Got it. So extreme doesn't mean over, it just means intense.
Correct. And that connects to the bigger picture of momentum.
That brings me to the final indicator at the bottom of the screen, the RSI, or Relative Strength Index. I see a white line that looks like it has fallen off a cliff.
The RSI is a momentum oscillator. It goes from 0 to 100. Generally, traders learn that if it is above 70, it is overbought, too expensive.
Yeah.
And if it is below 30, it is oversold, too cheap.
And looking at this white line, it is way below the dotted line. It looks like it is in the 20s, maybe even lower.
It is deep in the oversold zone.
Okay, so here is where it gets really interesting. I'm going to play devil's advocate again.
Please do.
If the RSI says oversold and the price is at a new low, isn't this the bargain of the century? Isn't the chart literally screaming, buy me?
This is the oversold trap. And I want our listeners to really internalize this. Oversold is a mathematical condition, not a guarantee of value.
Go on.
In a strong downtrend, an asset can become oversold and stay oversold for weeks.
For weeks.
Weeks. Just because the RSI is at 20 doesn't mean the price has to go up. The price can keep dropping, and the RSI can just hover at 20 or go to 15.
So the indicator gets pinned to the floor while the price keeps drilling?
Exactly. Look at the context. In January, during that consolidation, the RSI was flat. Now, in February, it has hooked sharply downward. It is confirming the strength of the sellers.
So it's agreeing with the price.
It is telling you, yes, this is selling off hard. It is not telling you the selling is over.
That is such a crucial distinction. It is measuring the intensity of the crash, not predicting the end of it.
Perfectly put.
So let's try to synthesize all of this. We are looking at a stock that has lost 35% of its value. It broke a major support level. It is walking the Bollinger Bands downwards.
Right?
And then notice one more thing. The volume on the selling days is actually creeping up again, isn't it?
It is. If you look closely at the volume bars for these last few red candles in February, they are rising.
What does that tell you?
Rising volume on a price drop confirms the trend. If the price was dropping on tiny, insignificant volume, you might say, oh, the market is just drifting, nobody really cares.
But that's not what's happening.
But when the price drops and the volume goes up, it means people are rushing to the exit. The conviction is on the sell side.
It's a stampede.
It is capitulation. The people who held on through November, held on through December, and held on through the false hope of January, they are finally throwing in the towel.
They can't take it anymore.
They can't take the pain anymore.
And looking at the chart, we haven't seen a reversal candle yet. Nothing green.
No. A reversal signal would be something like a hammer candle, where the price drops but then surges back up to close high, or a massive green candle that engulfs the previous day's losses.
We have none of that.
We have none of that. We just have red blocks closing at the lows.
So as of February 17, 2026, FirstCry is in what? Freefall.
We call it price discovery to the downside. The market is searching for a price where buyers are finally willing to step in and stop the bleeding. It hasn't found it yet.
230, wasn't it?
230, wasn't it? 229 doesn't look like it either.
Price discovery to the downside. That is a very polite, sterile way of saying bottomless pit.
The market is an efficient machine for finding the truth. Right now, the truth is that the market thinks this stock is worth less than it was yesterday.
It really puts the deep dive today. It is a sobering look. But I think it is empowering, too, because before this conversation, I would have looked at this chart and just seen a jagged red line.
And now?
Now I see the narrative, I see the resistance at the moving average, I see the trap in January, I see the panic in February.
That is the goal. When you understand the mechanics, the why behind the move, you stop reacting emotionally. You stop thinking, oh, it's cheap, I should gamble.
Right.
You start thinking, where's the evidence that the selling has stopped?
And right now, the evidence is zero.
Zero.
So what does this all mean for the person listening? I want to leave our listeners with a final provocative thought to chew on. In the investing world, there is this old cliche, don't catch a falling knife.
Meaning, don't buy a stock while it's crashing.
But then there's another famous saying by Warren Buffett, be greedy when others are fearful.
The eternal struggle.
Exactly. We are looking at maximum fear on this chart. Blood in the streets. So when you see a chart like FirstCry hitting new lows on February 17, 2026, with this much negative momentum, is it a bargain waiting to happen? Or is it a trap that's going to crush your hand? The chart is screaming, wait! But human nature whispers, discount. Which voice do you listen to?
That is the question that separates the professional traders from the gamblers, and usually the chart knows best.
A painful but necessary lesson. That's it for today's deep dive into the technicals. Thanks for helping us decode the red ink.
My pleasure.
Stay curious, watch those charts, and we will see you on the next one.